the Bank of Canada's interest rate and how it impacts our daily lives. The Bank of Canada is responsible for setting the interest rate in the country, and this rate can have a significant impact on the Canadian economy and individual Canadians. Let's take a closer look at how the Bank of Canada's interest rate affects you. First, it's essential to understand what the interest rate is and how it works. The interest rate is the cost of borrowing money, and it is determined by the supply and demand for credit in the market. When the Bank of Canada raises its interest rate, it makes it more expensive for individuals and businesses to borrow money. Conversely, when the Bank of Canada lowers its interest rate, it makes borrowing more affordable. The Bank of Canada's interest rate has a significant impact on the Canadian economy. When the interest rate is high, it can slow down economic growth by making it more expensive for businesses to borrow money for investment and expansion. This can lead to fewer jobs and lower wages, as companies may not be able to expand as quickly or hire as many people. Conversely, when the interest rate is low, it can stimulate economic growth by making it easier for businesses to borrow money and invest in their operations. This can lead to more jobs and higher wages, as companies may be more willing to expand and hire. So, how does the Bank of Canada's interest rate affect you? Let's take a closer look. If you have a mortgage, the Bank of Canada's interest rate can have a significant impact on your monthly payments. Most mortgages in Canada are variable rate mortgages, which means that the interest rate can change over time based on the Bank of Canada's rate. When the Bank of Canada raises its interest rate, it increases the cost of borrowing for banks, which can lead to higher mortgage rates. This means that your monthly mortgage payments may increase, which can put a strain on your finances. Conversely, when the Bank of Canada lowers its interest rate, it can lead to lower mortgage rates and lower monthly payments, which can make homeownership more affordable. If you have a savings account, the Bank of Canada's interest rate can also impact your finances. When the interest rate is high, banks will offer higher interest rates on savings accounts to attract customers. This means that you can earn more money on your savings. However, when the interest rate is low, banks will offer lower interest rates, which means that you may earn less on your savings. This can impact your ability to save for future goals, such as retirement or a down payment on a home. The Bank of Canada's interest rate can also impact the value of the Canadian dollar. When the interest rate is high, foreign investors may be more interested in investing in Canadian businesses and assets, as they can earn a higher return on their investment. This can lead to an increase in demand for the Canadian dollar, which can make it more valuable compared to other currencies. Conversely, when the interest rate is low, foreign investors may be less interested in investing in Canada, which can lead to a decrease in demand for the Canadian dollar and a decrease in its value. Finally, the Bank of Canada's interest rate can impact the cost of living for Canadians. When the interest rate is high, it can lead to higher prices for goods and services, as businesses may have to pay more to borrow money to finance their operations. This can lead to inflation, which can reduce the purchasing power of the Canadian dollar. Conversely, when the interest rate is low, it can lead to lower prices for goods and services, as businesses may be able to borrow money at a lower cost and pass on those savings to consumers.